morning, everyone. Mike Paciotti, iCM's Chief Investment Officer, back again for this week's Markets in a Minute. So it's a busy week for economic data, the Fed meeting, some major tech earnings, and fortunately, a quiet week geopolitically. So lots to talk about here, folks. Let's just get right into it. Starting with the Fed meeting, the April meeting was seemingly a non-event with rates held steady and little change in guidance. But like a duck on the pond, there was way more going on beneath the surface than above it. So a few key points here. Chair Powell noted that if inflation-related pressures, tariff-related pressures, I should say, do not subside, and if oil remains high, there is no chance that they cut rates, possibly a parting shot at President Trump, but a clear hawkish tone being set nonetheless. The result? Bond yields up, and the probability of cuts essentially reduced to zero for 2026, and some hikes in the mix for 2027. Something that we don't see as super likely as tariff pressures ease and energy prices subside. Now, later in the week, we got our first look at first quarter GDP coming at 2% versus 2.3% expected. The consumer was strong, contributing just over 1%, and fixed investment, particular non-residential fixed investment, think data centers and the AI spend, as well as intellectual property, contributing just about the same number. Now, as we drill into this, intellectual property development was about 70 basis points, and non-residential equipment, information processing, 80 basis points. There's some other things in here, but this is mainly AI, and it contributed 1.5 of the 2% annualized growth rate for the entire economy. So watch this, folks. There's a ton of economic chips pushed in on AI here. So PCE also released later this week, showing hotter than desired, but in line with expectation inflation levels for both core and headline. Once again, financial services and insurance contributing roughly 70 basis points, and healthcare another 80 basis points of the 3.5% annual total. Now, earnings this week. This is a big week for tech earnings with Alphabet, Amazon, Microsoft, and Meta all reporting on the 29th. The short version, results were strong with most companies beating expectations on revenue and profit. Alphabet stood out as the winner, delivering strong cloud growth tied to AI demand while keeping spending in check, a key. Microsoft also posted solid results, but a muted stock response as expectations were already very high for the stock. Now, Amazon and Meta, by contrast, were the clear losers despite good headline numbers as investors focused on their planned AI spend. The theme that emerged last quarter, where AI and AI spending were previously viewed as automatic positives, is no longer in the driver's seat here, folks. This is a show me the money market in terms of ROI on this AI spend. Now, related to this, as bond yields creep up, be mindful that stocks, tech stocks in particular, are long duration assets. So this is common among non-dividend or low dividend payers to have a higher equity duration or sensitivity to the changes in the discount rate. We haven't seen it yet, but be aware we are likely to see some pressure on equity multiples if bond yields, especially long yields, continue to creep up. So that's going to be it for this week. Next week, JOLTS data, some details on ISM new orders. Have a good week, everyone, and we'll see you next Monday.